Welcome to the deep dive. Today we're trying to get a clearer picture of employee benefit plans, financially speaking.
Right. Not just the company's books, but the plan's own reports.
Exactly. We'll look at the two main types. Defined benefit, that's the one promising a set payout, right?
Correct. And defined contribution, like your 401k, where it really depends on contributions and, well, how the investments do.
And getting a handle on these statements,
Yeah.
it gives you real insight into how secure those retirement funds actually are. Useful for everyone, really.
Absolutely. It's like looking at the plan's financial health checkup. So for defined benefit plans, they have a few key statements they need to publish.
Okay, so if we crack open a defined benefit plans report, what are we going to see first?
Well, first up is usually the statement of net assets available for benefits.
Net assets available for benefits. Got it.
Yeah. It's basically a snapshot. What the plan owns. Think investments like stocks, bonds, cash minus what it currently owes, like maybe for securities it just bought.
So assets minus liabilities at that moment in time?
Precisely. Our sample plan, for instance, might show, say, $7.8 million in net assets at year end. Gives you a quick look at the resources on hand.
Like checking the plan's bank balance. Okay, and how does that balance change over time?
That's where the statement of changes in net assets available for benefits comes in.
Makes sense.
It tracks the flow, how the resources went up or down during the year. You'll see things like investment income. Did stocks appreciate? Any interest or dividends? And importantly, employer contributions. Maybe the company put in $900,000 that year.
Right.
Then you see deductions benefits paid out to retirees, maybe $678,000, plus administrative costs.
So money in, money out.
Exactly. And the bottom line shows the net change. In the sample, maybe it was a net increase of just over $1 million for the year.
Okay, so that's the current financial picture. But defined benefit is about the future promise, isn't it?
That's the crucial part. And that leads us to the statement of accumulated plan benefits.
Accumulated plan benefits.
This estimates the plan's future payout obligations, but valued in today's dollars. It's an actuarial calculation.
So what they think they'll need to pay out later.
Essentially, yes. And it usually breaks down between vested benefits, the ones employees have earned a right to, and non-vested ones.
That seems important.
Very. For our sample, this future obligation might be estimated at, let's say, $13.2 million, often more than the current assets.
Whoa, okay. So how does that big future number change?
Good question. That's tracked in the statement of changes in accumulated plan benefits.
Another change of statement, okay?
Yep. It explains why that estimated future liability went up or down. Maybe the company amended the plan, say, making future benefits more generous that could add $1.5 million to the obligation.
I see.
Or maybe the actuaries changed their assumptions, interest rates, life expectancy, that kind of thing. That might decrease it slightly. It also adds the value of benefits employees earned during that year and subtracts the benefits actually paid out.
So it adjusts that future promise based on what happened during the year. Are there other key details disclosed?
Oh, definitely. They usually have to show how investments are allocated percentage in stocks, bonds, real estate, etc.
Diversification details.
Right. And expected benefit payments for the next 5, maybe 10 years. Also the key rates used in calculations, like the discount rate.
Okay, that gives a pretty good picture for defined benefit. How different is it for defined contribution plans, like that 401k?
Similar structure in parts, but the focus shifts. They also have a statement of net assets available for benefits.
Okay, same starting point.
Yeah, showing assets. But here, you might see investments listed at contract value alongside fair value, especially for things like stable value funds. The sample plan might have, say, $10.1 million in net assets.
And the changes for a DC plan?
Again, a statement of changes in net assets available for benefits, but the components look a bit different.
How so?
You'll see investment income, sure, but also specific types of contributions are usually broken out. Employer contributions, employee contributions, maybe rollovers into the plan.
So individual contributions are key here.
Absolutely. That's the core of a DC plan. Maybe contributions totaled $1.7 million in the sample year. Deductions or similar benefits paid out, admin expenses.
Right.
The sample might show a net increase of, say, $2 million, but maybe there were also transfers out to other plans, reducing the total.
Got it. And disclosures for DC plans, what's key there?
They often disclose the required employer contribution amount, if any. And a plan description is vital. Who's covered, how contributions work, vesting rules, that kind of thing.
So wrapping up, it seems these plan-specific financial statements, whether for DB or DC, really open up a window into their financial status.
They really do. It's about transparency. You get a much clearer view of the plan's health, its assets, its obligations or account balances, and how things are changing year over year.
It's complex stuff, no doubt, but understanding the basics empowers you as an employee or just an interested observer to grasp the security behind those retirement promises or accounts.
Couldn't agree more.
Considering how differently these plans report, one focused on that long-term promise, the other on current account balances and contributions, it really makes you wonder, how should we best evaluate the long-term financial health and sustainability of each type? Something to think about.
Definitely a key question in the retirement world.
Thanks for walking us through that really helpful deep dive.